Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Tuesday, April the 8th, 2025, recording this about, what is it, about 7:45 in the morning. Okay, so we're seeing overnight markets having a little bit of a kind of a recovery in the stocks, a little bit of risk sentiments, a little bit better after a lot of volatility yesterday. I think everyone's been following the news. We know that there was a sort of a fake headline yesterday which basically put the stock market up 3, 4, 5% within a few minutes, essentially saying that Trump had been thinking about negotiating for sort of 90 days, and the market quite liked that. But then subsequently, Trump came back and said that was fake news, and so the market went down again. So a lot of volatility. But clearly, what was interesting about that headline, at least from my perspective, was to show that the market reaction. And so what we know now is that any kind of serious headline or serious confirmed news, shall we say, that Trump is open to negotiating the tariffs, specifically and hopefully with like a 30 or 60 or 90-day grace period. That would be very well received by from a risk perspective and from the equity markets. But in the meantime, we don't have that. And in fact, what we had was Trump's reaction yesterday, essentially doubling down and threatening to add another 50% of tariffs on China. And we know that tariffs have a diminishing return over time the more you put them on. So that's kind of, sort of a rhetorical, political rhetoric more than anything. And then, of course, we had China sort of pushing back and essentially saying that they wouldn't sort of negotiate with anyone or any country, which was showing kind of bad faith. So it looks as though some people are saying, and it's an interesting point of view, that maybe Trump will start looking for negotiating sort of pathways with maybe Europe, Australia, Japan. We know that Treasury Secretary Bessent said that Japan would be the top of the list, and maybe China will be left on the side as just to stew a little bit. So that's going to be interesting to see. But in the meantime, the big thing yesterday, which happened, which you have to keep a look on today, is the yields at the long end of the German, sort of the US curve. So we see here the US 30-year up a lot. So what is interesting is that when we got the open on Sunday night, the yields actually were down. There was kind of very much a risk off sort of feeling. And then suddenly that reversed quite a lot. And it's interesting to see why the yields on, especially on the long end of the curve. So we have the 30-year here, and then we have the 10-year, like a huge rip higher in the 10 and 30, but also at the front of the curve as well. Not as much, but still pretty pronounced. But if we look at the long end of the curve, some of the thinking here was that, if the US were to go into a recession, that means that the chances of the deficit going down would be minimal. And in fact, if you look historically during most recessions, the deficit in the US deficit spending has normally gone up like 8, 9, 10%, just because there's less tax income, there's more sort of benefits and social spending going out. So it's very, very difficult in a recessionary environment to cut deficits. In fact, if anything, normally, as I said, historically they go up. And so I think then the market was saying, well, hold on, if we get some kind of recession, the deficit will definitely not go down. In fact, we might get more sort of need for bonds and spending, and therefore decided to push up those long end yields. We also have, of course, the problem that inflation seems to be remaining relatively sticky. We're going to get CPI tomorrow, so it's going to be interesting, and PPI later in the week. But the other thing as well is that if inflation's got to remain sticky, plus extra deficit spending in a recession, that means like the term premium. So that's the extra money which investors want as sort of a risk premium, not knowing what's going to happen in these longer dated tenors. That's going to also push up the long-term yield. So we got that up as well. And then there's also a bit of a conspiracy theory going around. Is it true? I don't know. That maybe China, as a kind of a sort of a little signal, symbolic signal to the US, is potentially maybe dumping or selling some of their holdings of long-term treasuries into the market, and that would have caused the yields to go up. I don't know if that's true, because at the end of the day, that would be kind of an own goal, shooting yourself in the foot for China to be sending, the price of their holdings down. But it's possible. And what is interesting, if we think about that, is to look at the auction cycle. So we have 3-year auction today at 1 p.m. Then probably more importantly, we have the 10 and the 30-year tomorrow and Wednesday. Tomorrow, Wednesday, and then Thursday. So we have an auction cycle. The 3-year, as I say, I don't think that's going to go particularly poorly today, but it could be interesting tomorrow if we get some kind of sort of rejection or a tail. Risk assets would definitely not like that. So that's something to be looking at tomorrow at 1 p.m. and Thursday at 1 p.m. is the 10 and the 30-year auction. Because that, if the Chinese want to send a strong message and stay away from purchasing US treasuries, that would be a good opportunity. But as I say, that would cause a hell of a lot of volatility. So just talking, continuing about this curve here, we see, did the curve steepen? So the curve was steepening, but as you guys can see here, the 230s, actually on this daily chart, we can see that it's actually come back. It's flattening, if anything, a little bit. And that indicates that these yields have been going up, all across the curve. And we'll see in a little bit, I'll show you just what's going on with the Fed. But just while we're talking about China, also very, very interesting to keep an eye on what's happening with the Chinese renminbi. If we look here, I'm going to use the offshore one. So the USD CNH, the traded out of Hong Kong, let's say. And what we can see here is that actually has weakened a little bit here. So you can see here, sorry, has not weakened. So you see here that the US dollar actually is strengthening against the Chinese renminbi here. And so what that means that the Chinese renminbi is weakening a little bit. So this is a very, very interesting level here, because if we get up to this level, which is about, let's call it 735, 736, as you guys can see here, this hasn't broken since October 22 and would have to go back a long way. I don't even know if we get back to that level, but so that's a very, very significant level. And over the last 4 or 5 years, the Chinese authorities have actually defended that level. So really what's going to be interesting here is to see whether when the Chinese do the fixing every evening, normally about, was it 9:30 p.m., whether they allow the US dollar to strengthen and push this further. So we'll see that this will be, as it goes up, of course, that means it's the yuan or the renminbi is weakening. And the point is that the Chinese could be basically saying to the US government, hey, you want to put tariffs on, no problem. We will simply allow our currency to weaken a little bit, which will make our exports a little bit more competitive and reduce the problems about tariffs. On the other hand, though, remember that China does have a long-term goal of making the renminbi a little bit more of an international reserve currency. Also, the other issue is that if Chinese, that would also make it a weakening Chinese renminbi would make it more expensive for imports back into China. So there'd be domestic sort of repercussions on the Chinese consumer. And thirdly, there's sort of been some talk that, let's say, for example, China wants its companies or Chinese companies want to expand and invest overseas to change supply chains or whatever. A weakened sort of Chinese renminbi would actually sort of be disadvantageous for them. So it's going to be interesting to see what happens. We're getting very, very close to these levels here. As I say, about 7.4. Definitely be watching that. And, if you're interested, you can be looking at the fixings just to see what kind of message at about, as I say, about 9:30 p.m. Eastern time when they do that. So that's going to be an interesting one. I don't know what's going to happen here. If this breaks through, this could go a long way. So that's definitely something to be looking out for. But just getting back to the Fed, what we've seen, and I'm just going to bring up a chart here let's just see what's going on with the Fed here. And as we know, Powell didn't particularly say too much. He was, if anything, a bit hawkish last Friday. What we're seeing now in the US is that, use as a benchmark, let's say December pricing, we'll now have 3.5 cuts, so about 90 basis points priced in. But what you guys can observe here, this is just on a tick chart going back. And again, this is the number of cuts. So this is the number of cuts, not the basis points, the number of cuts priced in by the market. And we can go back to the 2nd of April. And this is when Trump released the details about the tariff. And initially what we could see here is that there was a big sell-off, or what can I say, a repricing down. We got down to about, almost 5 cuts priced in. And the market's logic there was really much focused on the hit to growth, saying, oh my God, these tariffs are going to sort of cut, sort of growth in the US. And so therefore the Fed will be obliged like a white knight to sort of ride to the rescue and cut down to 5. And then over the weekend, we got further sort of, aggressive rhetoric. And basically by, let's say about 6 or 7 p.m. on the Sunday night, we had, what was it, over 5 cuts. You see over 5 cuts priced in. But since then, we've seen that the market has actually sort of repriced much more sort of neutrally. And as we speak here, as I say, on Tuesday morning, we're at about 3.5 cuts, which probably is, about right. So about, as we say, about 85, 90 basis points. But that's kind of being repriced much, much less dovishly. And that's also on the back of yesterday of the yield going up a lot at the long end of the curve. And so there's quite a lot of complex dynamics at the moment between, will growth sort of suffer because the tariff policy, and therefore the Fed will need to come in and sort of cut aggressively. On the other hand, will there be more deficit spending, so yields need to go up, and inflation is still sticky, so the Fed is in a place where it can't cut too much. So it looks as though what we're trying to do here, the market is trying to sniff out or establish some kind of trading range here, and it looks as though the most dovish sort of panicky mode is around about five cuts. And maybe, let's say, about 3 cuts could be sort of the base range. So I think just for the moment, we'll probably just be sort of trading between 3 and 5 cuts in terms of the December SOFRs. And probably, any rhetoric either side will determine which way we go. Now, if inflation comes in hotter than expected yesterday, could this get up to 3? Absolutely. On the other hand, if inflation is cooling and we start to get any sense of a cooling economy and real economy data, especially the labor market, this could definitely drift down towards 4.5 cuts in a hurry. Just in terms of data, as you guys can see here, not a huge amount. What is interesting is that we've got the small business optimism survey came out a couple of hours, or actually an hour and a half ago at 6 o'clock. That looks, I haven't seen the details yet, but this looks like it's lower than expected, which I guess in this environment is probably reasonable. What would be interesting, I don't have the details just here with me, but what would be interesting is to look at the hiring plans, the plans of small businesses to bring on workers, to hire workers. In the past, that's been a pretty accurate leading indicator of sort of future employment trends. So definitely after I do this little video here, I'll be looking at that just to see whether the small business survey shows that small business owners are looking to hire more people. If not, that could be a signal that the labor market is sort of slowing down a little bit. In terms of other stuff, let's just look at what's going on. As I say, just a little bit of a risk on recovery, not huge moves, and the market is still very, very, very delicate. If we look, there was the Chinese renminbi. Obviously, if we look at the volatility here, we can just look at, I'm going to look at the first of, this is just the futures contract actually, so not the VIX, but we can see just looking at the futures contract here on an hourly chart, again, we can see on Sunday night here, you see how VIX on the futures chart spiked up to about 40. Subsequently, it's been faded now down to 30, a more reasonable 30, but still pretty high on the in terms of volatility. If we look at the VIX here, just on the daily chart, again, you can see that this is the VIX index itself, still pretty high. So, and in terms of the curve, what that seems to be showing us is that the curve is still in backwardation. So, which is saying that the VIX. So you see here, this is live data here. So we can see that the VIX spot price is still at almost 41. So still over 40, very, very elevated, although it has come down. And again, there's that futures chart, which we were looking at, which has come down. So yeah, has it come down? We can look at towards yesterday. So this is yesterday in the orange, and you can see that all the values have come down, but still, we still have very elevated levels. I don't actually have the futures up just yet, but presumably extremely high, like cost of straddle and whatnot today. So extremely high volatility, and that means that we're still in a delicate situation. So if we look at the equities, let's just look at the futures here on a daily chart. Now we can see that on the Sunday and basically yesterday we have had a bounce. So, okay, great. But as you guys can see here, all of the moving averages have very much moved over, sort of rolled over. Now, why has it bounced? We look here at this Fibonacci extension, and we can see that this was sort of, it was, measured out to, let's say, about 5,200. We absolutely ripped through those. And so this was extremely, sort of oversold. The next thing to do at this point, at least what I'm going to be doing is, well, I'm going to be grabbing my, sorry, I just want to grab something here, just bring these down. Yeah. So what is interesting here would be to start looking at sort of levels in terms of the fib. So even if we take this shorter term fib here, we can see that we've got up to the 382. So this is a pretty key level. Actually, I'm going to get rid of that one. I don't particularly like that one. Sorry. Reversal here. So if we take the shorter term fib, we can see that we're at the 32% retracement level, which is about 52.30. Now, so somewhere around about here, this is pretty critical because at this point, this is simply a reactive bounce. We can't say, oh, suddenly the market, all the danger is over. We have a very high VIX that's indicating, maybe 2.5% moves. So this could be down here just on any particular headline. On the other hand, of course, it could keep on pushing up. I would say that we're only starting to recover really if we get above this 61.8% fib retracement on the shorter dated fib, which coincides with this. So I think we really need to be getting up to about 5,500 just to sort of breathe a bit easier. But on the other hand, again, just looking from a technical perspective here, if we take the longer term fib, looking all the way from the fall, beginning on the 19th of February, we haven't on this margin, on this measure, sort of even got up to a 38% recovery here, which would be about 53.48. So all that to say that I think this is a pretty key level here, about the 5,500 level. That's the one I'll be just watching on the shorter term, just to see how we go there. You know, the market, I think, really to turn around at this point would need to see a significant concession from a major trading partner. Obviously, China would help, but let's say something from the European Union. And again, it needs to be some kind of off-ramp, which would allow Trump to, sort of to save face and to say, okay, we're going to have a negotiating period of, I don't know, 45 days or 60 days, and then the market can just recover a little bit. So for sure, we have had a little bit of a risk on this morning. We see the ES up, we see the NASDAQ up, maybe even see the Russell up a little bit, not quite as much. So we are seeing a little bit of risk on this morning. We're also seeing things like some of the Aussie currency. We're seeing Aussie also up a little bit. We're seeing New Zealand up a little bit. We're seeing the Canadian dollar, the USD CAD. We see USD down a bit against CAD. So we're seeing the commodity currencies having a little bit of recovery, which is actually quite interesting because normally they're a bit of a proxy for China. And we saw that the Chinese currency was down a little bit. So maybe the market is slowly sort of saying, okay, China and the US are kind of in a big fight, but maybe we can avoid that a little bit. I don't know. I think ultimately things like the Aussie and New Zealand will be very much tied to what happens between the US and China. But what's also interesting, just looking at some of more of these sort of pairs here, we see that the U.S. Struggling again against the Japanese sort of yen, so not doing particularly well. They had a little bit of a bounce, but that seems to be fading this morning. And again, just if we look at the euro, we can see here that the euro is finding it hard to push higher because ultimately, it's still under quite a lot of pressure in terms of, sort of trade. Now, just talking about some of these sort of overseas stock indices here, if we look at the Nikkei, I want to look at, just got a couple which I want to have a quick look at, which let's have a look here. So obviously, a lot of the pain has been has been borne by sort of some of these exporting nations in Asia. So if we look at here, something like the Kospi, which is the Korean index, of course, we can see that it basically bounced pretty key level here, around about 305. But again, you can see that this has had a very, very big sell-off. All the moving averages are falling. And again, if we were to do some kind of, where this could ultimately lead to, we could measure this move out, for those of you who like Fibonacci's and whatnot, we can measure this out. First of all, that was the first target, but definitely we have a bit more downside potentially. And at this point, similar kind of situation, this is still a pretty weak bounce. And in fact, what we can see this morning is that we had a bounce, but we didn't even get back to the 38%. As you can see, it's already sort of turning downwards again. So this looks to me as though there's more downside. If it breaks this 305 here on the Kospi in Korea, it could have a lot more downside. Similar situation in terms of the chart action, in terms of the Nikkei. So what we can see here is that the Nikkei is actually, it bounced like the Kospi in Korea. It bounced again off this, like a sort of a triple bottom here. But again, we have to see a bit more positive price action this morning from out of Japan compared to Korea. Korea is very sensitive as an exporting nation. But again, we need to see this sort of clearing a lot higher just to make sure that this is not just a reactive bounce. Similar kind of situation for the Topics, which is the other main index over in Japan. We see that bounced off a sort of significant level. But again, we need to be sort of putting our sort of Fibonacci's in and saying, okay, this is the first hurdle is the 0.382 here, but it really has to get a lot higher before you could say that this downtrend is actually over. Other things we can look at some of the other risk assets here. Oops, sorry, let me just go back and put this on that. Oil continues to be weak. And that's just because a lot of the commodity space is weak. We had a little bit of a bounce this morning. If we look at something like gold, let's have a quick look at the metals here before we look at oil. Hold on, where's my gold? Yep. So we can see that gold up just a little bit, but still kind of weak. But the reality is that gold, often in a liquidation event, people, sort of fund managers are selling gold just to sort of, take some profits. And we have to say that, in this sort of trade war potentially against China versus the US, gold will no doubt continue to be bought by the central bank of China. There's sort of inflationary risks. De-dollarization, debasement of fiat currency. So it's interesting that gold here looks like an interesting level there on the futures. Looks like it found some support here around about 29.70, something like that. Let's see if that can push up higher. Interesting to see also what's happening with silver. Again, silver had a nice little bounce, very, very oversold. I mean, if you believe in the sort of gold and silver here, this is probably an attractive level even further down to maybe grab a little bit of silver. And the interesting one, of course, has got to be copper. Copper was absolutely destroyed on this sort of negative sentiment. It bounced off, sort of very, very oversold, bounced off some levels here, which we can see more or less here. But as you can see this morning, a little bit like the Kospi in Korea, not doing particularly well. So just finding it hard to rally significantly. And we could see a little bit of divergence of performance between, let's say, something like gold, silver in the middle, and copper sort of really underperforming here. I mean, ultimately, I think we'll need some kind of resolution or positivity coming out of China and global sort of sentiment before we can see copper really rip a lot higher. Just again, just to finish off here, just want to have a quick look here at oil. As I was saying, oil, there's a lot of reasons to be pessimistic on oil here. And you see it's finding it difficult to rally, absolutely slaughtered. I mean, it's very, very oversold here. We can see that it broke down through all the stops, now around about $60 on the WTI. For sure, there's reasons to be pessimistic. Global scare, fear about a global growth slowdown. OPEC Plus starting to pump a little bit more. We know that the U.S. administration is absolutely talking down oil. They're really. It seems like a very important part of the US's plan is to have oil prices lower to sort of help with inflation and make energy in general lower. So not getting a lot of love here. We'll see if we get a little bit of reactive bounce up to 65, 66. Again, it could be sort of a hostage at this point to sort of trade talks and tariff talks. But definitely from a risk reward point, I think this is interesting to have a sort of dip the toe in, maybe with small size for just a quick reactive bounce, as I say, up to about 65, $66 here on WTI. But any more negative sort of sentiment or news that could definitely cause a little bit more of a flush out. And we saw this morning, I think there was a Goldman Sachs note saying that in the worst case scenario, oil could go down to 40, in a very bad case scenario. We shall see. And some people are saying that, China will stop importing as much US oil because of the tariff situation, which is, probably net not great for sort of the WTI. I just want to finally look at just a different product here, guys. I want to look at coffee. Specifically, I want to look at the Robusta sort of contract here. And what we can see, if I can find it, where's my Robusta? Yeah. So just kind of interesting. We know that coffee has had a very, very powerful sort of run higher over the last sort of 18 months or so, just sort of falling off here. And basically, it did have a bit of a bounce. But again, pretty sort of weak price action here. And at this point, it still potentially could test these lows and go down a little bit. We know that the RSI, we know it's very, very oversold from a sort of a technical sort of perspective here. And we throw on, let's say, just sort of some technical indicators here. We can see that, it could have a little bit of a reactive bounce here because it is very, very oversold. If you look at, the MACDs and the RSIs of the world, these kind of things, very, very oversold. But ultimately, the trend here is still signaling the overall trend, which is the purple, is still signaling a downtrend. But it could have. It's a difficult one because the moving averages here, the 200 is still moving up, but the shorter term ones are moving overwards. So I would say anyone's still in a downtrend here, maybe sort of hold, but could we have a reactive bounce soon? That's definitely a possibility. And keep in mind that part of this, though, and again, this is going to depend on the Trump rhetoric. Remember that Brazil and Vietnam are the two of the world's largest producers of coffee, and of course. Vietnam was had some of the most severe sort of tariffs slapped on them by the US, which is not going to help the sort of the coffee, the Robusta kind of prices. So for those sort of trading Robusta and coffee in general, keep an eye on any sort of announcements from the White House about a sort of a tariff reduction on, especially on Vietnam, but also on Brazil in terms of coffee. I think coffee would enjoy any reduction in tariffs on Brazil and Vietnam. Okay, guys, I want to leave it there for today. Hope that was useful. We shall keep the conversation going. Thank you.